we have a couple of situations impacting the market. And first and foremost, there was, I don't think we heard a lot about it because it went the right, quote unquote, went the right way today. But there was a lot of angst about some of these interim elections, these special elections, and so far there have been 4. These are, of course, to replace the seats of the people who took administration positions, and they've all gone Republican. So I think that that was a good thing for the president and his agenda. So I think that that's kind of a bullet that the market dodged. I think if that Georgia election in particular would have gone the other way, the market would not have been happy. So that's out of the way, elections. The next part is the Fed. I did a very detailed breakdown of my take on the Fed in last week's video. I'll just touch on that very briefly here. The Fed had a bit of a more hawkish tone. Interesting, though, that the market didn't really have too big of a hiccup on it, and it did have a pullback, but the bond yields have been dropping. So I think the market is trying to call a little bit of bullshit on the Fed. We'll see how that plays out, but the probability of a rate hike in September is very low. They took that off the table. So I think in the meantime, people see that we have higher rates here. And they have lower rates in Europe, so they're selling those bonds and buying our bonds. So I think there's that kind of a implicit spread there. I think some of these European bonds, by the way, I got to figure out a way to do it. If anyone has an idea about it, message me. They are going to be some of the best shorts, potentially of a lifetime. They are way too expensive for their credit quality in comparison to the US. Here is where we get a little sticky, and that would be with oil, right? That's been weighing on the market for the last couple of sessions, and today was we had a drawdown. It's been hot. I can see why there might be in gas and natural gas and stuff, but there's some issues. One is the drawdown wasn't as big as it was supposed to be. There was an initial bounce, but it faded, and I had said that it was nice to see a drawdown, but we weren't out of the woods just yet, and that was a little bit prescient. I'm looking at the oil chart right now, and it looks to me like a very large rounded top with lower highs now and lower lows, and the question is going to be, which type of a decline are we in? Now, I'm going to lay out I guess the best case, the worst case, and I guess the most likely, if that makes sense, or at least as I see it as most likely. All right, so we weren't able to hold above 49.33. That's kind of the 49.33 to 49.61. We've had ample opportunities, and the market has sort of rejected that, and we've lost the kind of uptrend we had from the, when was this? Last August lows, I guess. So seasonally, this is technically supposed to be good for oil, but it has not been acting well. You know things aren't going well in oil land when crown princes are being fired in Saudi Arabia. For crying out loud, I didn't even know if that was possible. But you had a firing of the crown prince. You have a new crown prince. So if they want to, if they need a new crown prince, you know, they could give me a call. It'd be interesting, right? So we broke some important levels today. We're below 42.49. Now I was just going through with my little calculator. I take my iPhone and I take a peak of a move and I go to a trough of a move, and I calculated, and it looks to me that we have declines roughly of $10 to about $12.50, and then there are the larger declines that are roughly $25. So what does that mean for us here? It means that if we're in the $10 to $12 variety type of decline, we're getting close to the end of it. we're already down a bit. We're already through like the 10, so maybe there's like $2 down more of the move. If you take a Fibonacci retracement of the bottom that was struck in 211, that was of 2016, and you go to the peak we hit in January 3rd, the 50% fib is roughly 40.65, and you have a reference low down there at around 39.19. So that lines up well with like the 10 to, or let's say the $12 type of decline. Now here's where it gets tricky. If we're in like the $25 decline scenario, that means we got a lot more to go, and it means we could be looking to retest down as low as $30 in oil. So we're not going to know just yet which scenario we're in, but we will know soon, if that makes sense. Now, there are some important levels in between there, like I had mentioned. 40.65 is the 50% fib. There was a very key level I have written down on my chart, and this was sort of the breakout from the '09 lows of $37. You have a pullback low in there of 35.24, and then there are some reference lows in 33.20. So this isn't going to be such an easy break. I think that area will hold. I'm sort of the opinion that my worst case scenario here for the decline would be oil bottoming somewhere between $30 and $35 as the worst, maybe 37. So that's the scoop. Either we're going to bottom in the 40s, or we're probably going to be visiting 35s to 37s. So buckle up. If we can now hold 42s, like let's say tomorrow is an up day. If we were to negate the entire bar of today, which would take us over the high of 44.20. Now listen, this isn't obviously very likely of a scenario, but it's very possible. If that were to happen, I would say today was a look below and fail, and that we probably will go back up to retest at least the 20 or maybe the 50 MA. I think this would catch a lot of people off guard. Now, the one thing I will say that the bulls do have going for them is that you didn't close on the dead low today. Did we close? Let me see. Where was the RTH close? Close was above 42.49. So that's good. But and we held the channel low. Things are still very controlled. We're in a very controlled decline. That's why the market hasn't really gotten crazy yet. We've been stair-stepping down. We haven't gotten the sort of the panic. So those are the levels. That's it. Either we're going to hold this like $10 to $12 decline, or I think we're looking at the $25 decline scenario, and we won't know until we see either 42s or 40s hold. If we start losing there, I think you can kind of start putting on bear positions for a move lower, and you would probably see 37s. Now, here's an interesting thing I'm looking at in XLE. I've been waiting and waiting and waiting for XLE. It's almost like waiting for Godot. By the way, I saw Waiting for Godot with Patrick Stewart and Ian McKellen on Broadway a few years ago. It was so amazing. It was actually a sort of a boring performance, like a boring. I didn't find the subject matter interesting, but I found the performances fantastic, if that makes anything. I'm a big Patrick Stewart fan, by the way. Also a fellow Brooklynite. Anyway, that's neither here nor there, but while the chart was rendering, I got in a little bit of an anecdote. So we're right on the support here. This is why I had said that all of these levels are kind of coinciding with what's going on. Check this out, 63.5, which today's low of day was 63.64. That is really my sort of range low, and it's roughly coincides with this 50% fib, which is 64.19. I don't necessarily know that it's going to hold because we're kind of just breaking. Like I was hoping the last low had more extension here. and that was a couple of weeks, like a week or so ago. Here's the scoop. There's a gap fill and a 61.8 down at 60.82, which also would coincide with a channel low. So if there's some kind of a flush lower in XLE here, down into that level, it might even push past, maybe into 59s or whatever. I'll be looking to sell out of the money puts, probably like 56 strikes and below. That is the, like, sort of legging into it. That's the 78.6. So I'm looking for a bit lower. Like, what I would also like to do is maybe some put ratios here, where you could, wow, I'm going to have to start wearing sunglasses here. This is getting so bright. You're going to have to, I would play for that. There could here be an oversold bounce, and we could respond to the 63.5 low here. Again, today's range is going to be key. I would say you could either play long above, because you now have roughly 2 days worth of trade with equal highs. So if we were to catch a bid above today's high of day, I'd say you could buy stop it for probably a quick rush up to 67, which is roughly the 50 MA, or we could get that flush down into that 60-ish level, and I would say that that area would be where I'd start looking to sell some out of the money puts, like that 59s to 60s. So keep an eye on XLE. I've been watching ExxonMobil. That got the, it's weird. I noticed into options expirations, it has like these bids, but it's been in a big range. Today was an outside reversal day of a hammer. It still closed inside of range, so it wasn't like the be all of end all, but like when we get to 80 in Exxon, it seems to be like the buy, and then when we get to like 83, 84, like high, almost 84, that's the upper end of range. I've been looking for some kind of a washout down into like 77s. That's the 61.8. It's interesting to me here that Exxon has been holding up so well. I know it's not like an amazing chart here, but Exxon is very key. I've noticed that Exxon turns before the commodity. That's been a big tell in the past. Same thing with Chevron. We're nowhere near those lows, and it's kind of holding up. So that gives me a little hope, I would say, that I shouldn't say hope, because I'm not hoping either way. I'm actually hoping for a bigger flush in oil to kind of load up into these stocks again. But it gives me a little bit of, it puts a little bit more weight for me that the $10 to $12 decline, not the 25, might be the case. If you start seeing these stocks breaking down and making new lows, then we got the $25 scenario back on the table, big league. Another thing that had my ears up, and I mentioned this, that I was starting to see a little weakness over the weekend video, was in HYG. That's the high yield situation. Now, this can often become a self-fulfilling prophecy, and we're going to go through this. This has declines. It has these very hard and very fast declines, and it gets everyone super duper nervous. Now, my opinion of this is that I don't believe that I think we're in an upswing with growth. This is very controversial right now, by the way, as far as where people see growth going. I'm probably on the higher end of the spectrum for where I see growth swinging, not even so much for 2017, but more so for 2018. And I don't really think that when you're in an upward swing with that, and numbers are sort of in an upward motion, that you're in recession mode. So I think that this is sort of a unique situation where that is because of oil. You have these companies that are highly levered, and they're loaded up, and you see these dramatic pull downs in oil. I will say this, though, if this does start getting steep, it will definitely get the Fed's attention, because we know Yellen has told us they look at this stuff. If you actually listen to Yellen, I'll tell you, one of the reasons I did so well in college, graduating in the upper portion of my class, was because I took these meticulous notes. I was able to go in, listen to what the teacher said, and do very well on the exams. Believe it or not, I would learn entire semesters worth of courses in 2 to 3 days because of meticulous notes. I do my homework and stuff. I wasn't really a big studier other than cramming for exams, and anyway, I'm getting way off tangent here. I take good notes on the Fed. I listen to Yellen. And some of the things she talks about, I've expanded my Fed keys. We started at 7, and now we're at 10. And she has mentioned that she looks at, they look at financials. They look at the HYG. She outright said the spread of high yield over treasuries. So Hig, this is a big deal. Anyway, we're coming down. I don't start getting too worried about this until you lose the 200 MA. Now today we had a snap of the 50 MA which accelerated, and we actually got a close today below the 100 MA, which has me thinking we could be looking to maybe retest this 8704 200 MA. There have been breaks of it, but moves below have been unsustainable. Now we have reference lows at the 50% fib around 86. So we kind of had a higher high here. I'm not going to get crazy about this thing saying we're transitioning into a bear state unless we start losing really those reference lows. So the 200 MA is very important to me. And I will say the fact that today was the first day of a trend break has me thinking that it's probably a short on bounces here for a move lower, and you could do that with put spreads or put ratios. It's also a great portfolio hedge. So I'm watching HYG, but I do think that there's a bit more down to go, and that a rally here could probably be shortable. What else did I want to talk about with regard to this? Let's talk about the bonds quickly. This is all macro related, and this is what's really ruling the roost. Now, the market has been going lower, but FANG and the FANG cohort have been going higher, and I mentioned that the other day. And Goldman Sachs actually had an interesting note. I'm not a huge fan of their work, believe it or not. I think that, I don't want to get into my feelings on Goldman Sachs, but I'm not a big fan. They were saying how they thought FANG has been being used as a bond proxy. I mean, if they watched my videos, I could have, I've said for a while that these stocks need low interest rates. If you look what happened in 1999 and 2000, what crashed the tech bubble was jacking up interest rates to 6%. In 1929, we topped out at 6%. In 2007, we topped out at 6%. That's the breaking point for tech. That's the breaking point for the market, by the way. We also know from the Fed that they've said that they're going to normalize at 3 to 3.5%, although Yellen now was fudging in this past meeting where she said that they may consider upping that target rate. I don't want to hear that out of her. We don't want to hear anything like that out of her because that means more interest rates hikes. Anyway, it seems now a fait accompli that we're going to retest and fill in that gap at TLT 130. This is why we are seeing strength in the tech names, the momentum names, because they are gluttons for low interest rates. When interest rates are suppressed, and remember in 2013 when rates, it really annoys me when you listen to TV personalities who don't understand what they're talking about. Any day, any time, I am happy to debate any of them on air. They can do whatever prep work they want. I'll just go on my LOSIM without the notes, and I'd be happy to debate with them the interest rate policy and the effect of it on the market. There's this great misnomer that low interest rates are bad for the stock market. This is complete this is nonsense. Low interest rates are the fuel for higher stock markets because there's something called DCF, discounted cash flow analysis. If you look in the description of this video, I put a link to my alma mater with a spreadsheet. I was actually thinking about creating one on my own for this, but there was actually a pretty good one online already. And I'll say this, I'm not one of those people who need to reinvent the wheel all the time. If there's other good work that's out there, I'm happy to give credit where it's due, and I'm happy to use it when I can to help others. So if you guys really are that interested in this, though, we could do a a video on it and I'll really detail it. I guarantee you it'll put you to sleep. The DCF for dummies, like the cliff notes here, think of this as a simple division problem. This is like the cut me to the quick. Like if I was, out having drinks with friends, I'd explain it like this on the back of a cocktail napkin, which, believe it or not, I've done. I have some group of friends. So you have a numerator, a denominator, and an end product. So think of your top number is your price. Your bottom number is sort of your earnings, and the end is sort of your multiple. So if you're dividing your earnings by a lower number, meaning the interest rate portion is lower, you have a higher end product, a higher multiple. If you have a ballooning denominator, meaning that your end product becomes lower, you have a lower PE multiple, a lower stock price. If you've followed my work, my lower for longer thesis, I've said that the stock market deserves a higher than normal PE multiple because of the suppressed interest rates. Now, if you turn on the television, they'll tell you that the normalized multiple is 15. This is nonsense. There is not a normalized multiple for the stock market. It has a sine curve that is very slow, but it goes from being oversold in a recession at 10 times earnings to overbought in a bull market above 20 times earnings. And they just say that, okay, you have two extremes, so we'll divide it and we'll say 15 is the right multiple for the market. This is nonsense. That's never, ever been how the market has worked, other than in this, in television land. Anyway, the market, as interest rates are falling, deserves a higher PE multiple, and that is why you see, Amazon, Facebook, Netflix, Google, Tesla, all of these stocks. Tesla's a bit of an exceptional story that I would say that low interest rates help, but that's a whole other discussion. That's a market mechanics discussion. But that's why these stocks are all up big, and that's why they're going to continue to be up big as long as interest rates are lower for longer. We tested into the gap today. I don't necessarily know that you need to chase this here, but it does seem like that gap is going to fill close to 130. Which should be good for the NASDAQ. Speaking of the NASDAQ, I'm noticing one little thing that's concerning me, and that is that we're in a bit of a bear flag in the Qs. Now, you had a flagpole day, which was 6.9, and since then you've been bumping around in range just shy of the 50 MA at the channel low. No danger here yet because nothing is broken. But we are still below the sort of recent bounce high of like 140.93 and below the 20 MA. Does this mean that it is going to translate into a breakdown? No, but I am on guard about that, and I would say that if we were to lose the reference lows here, now you have double bottoms around 137.47s, 137.49, any breach of that, which would take you below a 50 MA and below a trend and below this consolidation here, I think like a lightning bolt we would see 132s. That's the gap fill and the retest of sort of the last breakout. The 100 MA also sort of lives around there. The trend line is roughly around where the primary trend line is roughly around where the 200 MA is. If it were to happen tomorrow, which it will not, it would be like 125s. That keeps moving up. So the longer we spend up here, the less of the decline that we'll have. An eventual decline, which will happen. Have we peaked in the NASDAQ? Could we not make new highs? That's going to depend on a few factors. I would say that the longer this sort of hangs out up here, the more like in range, the more vulnerable we get. So the quicker we get back up to the highs, the better. A lot of people think that just because you have a sudden break means that you're automatically going lower. The trick is how fast. It's sort of like it's not how well you mow, it's how well you mow fast. So if you accept price lower for a longer period of time, the probability in my mind and in the mind of the market of a translation lower increases. If you can get back up to the highs quickly, it's sort of nothing. It's just sort of like a pause or a pause and refresh. It's like the recharge. So I'm waiting to see here how we hang. I've been watching a couple of the big stocks like Apple, the ones everyone watches, Apple, Amazon. So Apple is sort of all right. I mean, it held the 100 MA. I was really actually hoping for a move back down to 140. It stopped just shy of there. I'm short some puts in Apple, so it's all right for me that it's not like going crazily lower. But this isn't seasonally the best time for Apple, and the fact that we're below a 20 and a 50 MA seems a little suspect to me. I'm guessing Apple at some point will fill this gap here to 149 basically, and at that point I'll reassess. So I'm a little suspect with Apple. I think that this is going to be range bound for a little while and could potentially go a little bit lower. If that happens though, the NASDAQ is going to struggle. Right now it's sort of like forming almost a bit of a right shoulder off of a topping pattern. I have been thinking we'll see 162s, but that might be a little bit later on in the year. I think you could watch the 100 MA here now as a gauge. Anything above is okay, below is not. Amazon. Now, one thing I want to mention also with Apple. It didn't close amazingly yesterday, but I was noted it kind of lost a lot of the value toward the end of the day. But I've been watching it, and it looks to me like there's someone sort of supporting the stock. The last time I made that call, it turned out to be Warren Buffett. So I guess I have a little bit of street cred when it comes to this stuff. I don't know if it was him or not, but yesterday Apple should have been down a lot more yesterday with the market, and it wasn't. So sometimes when something does something, sometimes when something doesn't do something, it's important. In the meantime, 145.36 is an important level for me, and I think you could use today's low of day as a stop if you're long Apple. Amazon. Now this has just been chopping through 1,000 sellers. The people who want to sell 1,000. You had a flash crash in Amazon, and I had said that I thought we were just going to be really choppy in that range for a while, and that's been sort of what's been going down. I also said that I thought it was a buy on the 50 MA, and it was. And then I remember the day before the big gap up, the Whole Foods day, I really was not surprised that Amazon was up big that day because we had held my tail line of support. We had a higher low basically off of a second retest of the 50 MA, and we had closed that day at 964.17, and I had said as long as we hold 962s to 965, that bracket, listen, there's $1,000 stock. You can't be like to the millisecond. You need to give a little bit of room, and I gave it that $3 range. It was fine, and we gapped. So what was the significance of 965? Why was that the big level? 427 earnings after hours high of day was 965. And as long as you're there, the stock is fine. I've said that. There was a lot of opportunity, I will tell you, on some of these plunges to sell out of the money puts. And that's when you want to do it in these like crisis situations because there's an inefficiency in the Black-Scholes option pricing model. I want to explain this briefly because this is what I do. How do I explain this? The Black-Scholes option pricing model assumes a normal distribution, meaning a bell curve, right? You have the bell curve, meaning, let's say a stock's $100. It means it's likely, more like, there's a probability it goes to 105, 110, 120, and it's priced in. When there is a big dislocation in price, meaning a big move up or a big move down, like let's say a stock gaps down $100, initially, those options explode. It's not a smart model. It's not dynamic. it assumes, starts pricing in that there's going to be another $100 move down, which is very unlikely, right? I mean, assuming we're not in, we're assuming all things are normal, meaning, we don't have nuclear war and, the Russians aren't invading, we're not waking up to Red Dawn. I mean, although I don't feel as comfortable now that we don't have Patrick Swayze to protect us, that it's not likely. So when you have those big dislocation, the options explode, the premiums explode, and you could start selling way out of the money puts or, on moves up or way out of the money calls that are never happening. But until you get that, you have the initial explosion and then the contraction of IV. So be opportunistic when those type of dislocations happen. Like I was talking about Chipotle with somebody yesterday, and they were saying, oh, are you going to sell puts into the move yesterday? And I said I would if we had like some kind of panic into the close, which we didn't get. Today we got into my range that I was starting to get interested in. I was busy with something else. I didn't have an opportunity to sell any puts, but I'm starting to get interested into another. Like if tomorrow was another big down day, I would probably be looking to sell some out of the money puts below the 394 strike. I would assume that we may want to pin 400 this week, so I would assume same week expirations below there would be okay. Same or next week max. Keep in mind when things start getting very steep, that's toward the end of the move, not the beginning. So yeah, that's what I was talking about with option pricing dislocation. Option pricing dislocation. If you're interested in that, just Google Black-Scholes and normalized, options pricing, and you'll see what I'm talking about. See, this is the kind of Periscope I really like to do because you don't need, not Periscope, YouTube Live I really like to do because you don't need to see my screen for this, and this is knowledge that you're probably never getting off of these dummies on television or, other, I don't know, whatever, people who are traders. So that covered that. Let's get into some of the some stock-specific stuff. Let's take a look at the dollar for a moment. And let's go over the Fed keys because that's going to be key to where we are. So the dollar had a look below and fail. We're almost up to the top end of the range. The 50 MA has, we have a downtrend within a down channel, and we're getting close. The 50 MA is just a little bit above that. So I would say the dollar probably could rally a little bit more, but might not have all that much left in the tank before it has at the very least a pullback. I'm looking at the metals also, GLD. We're actually right on my first downward target, which was the 100 MA, 200 MA confluence, and you have 3 days in that range. So I think you could either short it below the 3-day low for a move to trend, which is my real end buy point at like 116.70, or a break above the high for a move back up to the 50 MA. So that's what I'm watching in GLD. Silver is getting into my range in the 15s. That's usually where I like to sell out of the money puts, in like the low 15s. So I might have to reload on this. Remember, we took the trade. I said to bail at the 61.8, and that it went a little bit above, but now is way below. So that worked out well. We'll look to reload on that again. How about Bitcoin GBTC? This GBTC is ridiculous, by the way. It is so overvalued. It's a trust, and because there's no other real way to trade this, it gets the love. So this got basically just shy of a gap fill. I was looking for a little bit more down to 262s. I was really upset I didn't get filled on that because you see the epic bounce we had. I think this is just going to mark time for a while. This thing ran up so far so fast. I think this is just flagging out, and you have to watch to see it's making now some lower highs. You have 2 days here of roughly equalish prices. The 10 MA is now downsloping, and you're closed below you got to be above today's high in my view. Below it, you could have some retrace, but I think this thing is just going to mark time. Biotech, that's where the party is at, right? That has been on fire. Check this out, though. If you look back in my videos, I mentioned 315.55 as being one of my price targets. No surprise that it lined up perfectly with the channel high today, and we actually closed above it and the channel high. There's a gap fill around 321.12, so we could push up above the channel here. I don't love that it's so many days so fast. I'd say you may have another day or two of this, but I'm now back in buy the dip mode. The fact that we're over 301.80, it's all good in my book for this to be going higher, but don't be the schmo that pays up on, you know, after it's already rallied a lot. Keep in mind, this is kind of coming up from the bottom off the 200 MA, right? If you want to be a chicken little in this, and you know I love to be chicken little, or chicken hawk, sorry. I like to play chicken. If you want the chicken hawk way of, for you cartoon fans, how to play this, I like selling out of the money puts. I think you could sell them below the 200 MA on pullbacks, particularly if you have a retest of 301.80. At the very least, for a day trade, I think that would be a bounce play. I mentioned yesterday that Gilead started to perk up. It had a reversal, and today had some very nice follow through. And you're starting to make some higher lows and higher highs in that stock. It's like a 3% yield. I think the worst case scenario for Gilead is like 57s. That's the 61.8 of the like entire move of Gilead. This is I've made the argument that that this industry has seen peak earnings for a while. Gilead has a ton of cash, and everyone's just sort of been waiting for what they're going to do with it. My view for them is that they should, I don't know if they need to necessarily make some huge acquisitions, but you know, maybe they boost the dividend, increase the buyback. There's a lot they can do with that. I'm very leery when people tell me, you know, or tell successful companies with lots of cash what they should do with it. Although it did seem to work well for Apple. Look what they did. They boosted dividend, did buyback, and the stock did very well. So maybe Gilead should do the same thing. So that I'm watching. This Regeneron isn't one I watch very often, but it's getting close to a channel high. Wait, no, I'm sorry. You know what it's getting close to? The backside of the old uptrend line. So I would say into some strength on Regeneron. The big gap fill is 542.87, so you're late. I would say into strength, it's probably a good idea to book some. I do think it's going to have some, there'll be opportunities, you know, to buy the dip. And then, let me just want to see one thing here. The primary downtrend, like I said, not one I follow very often. Just want to see where this peaks out. You're right at it. Interestingly enough, you're right at the downtrend. It's like a little bit above and the backside of the old uptrend. So I'd be booking this into strength, particularly with the big move it's had. So yeah, Regen, you're a little late. If there's any kind of a pullback, I would be looking to sell like sub 400 puts in a pullback. You know, that would look all right to me. AMD. So today was a pretty good day. It broke the downtrend. I'm just looking at this. I think it looks all right, actually. I'm not a huge AMD fan. It filled the gap before and pulled back. And now today, I think you're a little late on this. I think at like around 1428, it's going to start finding some resistance. But you could probably start selling out of the money puts at or below the recent gap fill of the 12s or 11 strikes, like longer dated if you wanted to play it. But as long as this holds the 100 MA on pullbacks, I think it's all right for now. NVIDIA, keep that in mind though. If the NASDAQ starts rolling over, all of these are going to be under pressure. NVIDIA is just chopping around like I said it would in that big bar. I just hoping that there's some kind of a larger pullback in NVIDIA to retest that like 120 breakout area, which will happen at some point. What else are we looking at? CCJ. Cameco. Yeah, there was some big option buyers, I think in the September 9s the other day. So I have a small long on in this. We'll see how it plays out. It's a bit of a longer dated thinking. These guys, do the uranium and stuff, but it's below the 200 MA, and below the 200 MA is iffy, but there was a lot of options buying in that, and we'll see what plays out. Amgen, wow, a lot of biotech questions. I had been really bullish on Amgen years ago, and I sold too soon. I made good money in it, but it should have been even better. Retesting into the gap here. So we stopped right at it. Usually what happens with a move like this, considering you came up from the bottom, is that it doesn't fill right away. You'll maybe look into the gap, and then it'll back off. And then the next move into the gap is the one you want to buy. So I'd probably be looking to book some profits on this or sell out of the money calls, and then look to kind of buy the dip on a pullback. If it just kind of hovers here for a bit, that would be better. Listen, this just could go. I mean, listen, biotech has been so bullish. This could just go to fill the gap. I'm just talking about probabilities here. Usually there's some initial hesitation into the gap, and then there's a back off, and then the next one is the one to kind of play for the move in. That's it, all I have written down here. So let me do a few more that I see as important. Let's just go through this list. The transports. Let's finish up the Fed, the indicators, right? My Fed indicators. So let's just take it from the top, actually. Let's look at the VIX. The VIX is at the lower end of the range. Obviously, the risk is sideways to up in terms of this. Nothing to really, listen, been in a volatility downtrend for a while, and the apex of this will result in like October. Interesting, right? October is usually when things go crazy. But we're nearing an apex of this, and we'll either just continue by time or by price, which would be up. So down here is pure directional play. We did the dollar, we did the bonds, we did the oil. We didn't do China. Let's do China quickly, FXI. We did the high yield bonds also. China is just kind of consolidating some lower highs and some lower lows. I would like this if we could get down into like 30. Interesting. I had said in the weekend video, this could be forming a head and shoulders pattern. And if that were to be so, there could be some risk down to like 37s, 38s. So just keep an eye on that recent low here of 39.37, particularly if you're in like BABA, which I had mentioned I thought we would see a rally and that it would disappoint shorts. And bingo, you got it. I had thought we could press a little bit lower. Remember I said I thought we could see the 20 MA, but said that I didn't think that there was much lower to go in this and that I thought we would be back up into this area. So I would say a little bit more maybe in BABA up, but I would probably be looking to book some profits. Baidu is just chugging around. This thing is just a really nasty pattern. I think you could probably sell out of the money. It's like strangles in this thing because I think it's just going to be range bound for a while. We did biotech. Let's do the transports quickly. This is not a pretty picture. You have a bit of a, it's not ugly, but it's not pretty. It's sort of nowhere. I would say that I'm not too worried about this unless you start losing that 50-100 MA confluence, which would mean a little bit more down. Below there, it's actually a big problem. But here, you have a doji today. I would say you could be long above the high of day or short below the low for that move down. So keep an eye on that. FedEx that was a really wild move today. A big outside day range. 201 was the breakout. So let's keep it simple. You have a, I think we're going to chop around in this range for a little while, today's range. And it would be good if it was a few days, and then you could either buy stop it over the high or short it below the low for that retest of the breakout, which would be like below 205 to down to like 201 for a quickie. Maybe it would even press a little bit lower, maybe even get down to like I don't know, 98s or something. I don't mind playing some like put ratios, like you buy a put spread and then sell like even more further out of the money. XLF, that was weighing on the market a little today. You had a breakout above 2409 and now backtracking a bit. This invalidated the head and shoulders, but I'll say this, you need to hold the 2409, or I think we're going to maybe get a retest mid-range, potentially to like that 100 MA or maybe even the 50. As long as the pullback holds the 50, I'd say it's still like kind of like all right, but this is looking a little iffy to me, and 2409 is very important. If you lose that, it's a little bit more iffy. JP Morgan, let's just take a quick look at that. Remember I said this wasn't confirming? JPM also needs to hold that 50 MA on the 50 MA to 50, 20 is a little bit below there. Yeah, that 50 and like 20 MA confluence is the must hold. Below there, this thing is going to probably revisit the range low. And I think you could probably buy stop this thing up over 88.23 for a move higher. Is that it? Yeah, that's it for the Fed keys. Let's just take a quick look at the major market indices and we'll end there. Looking at SPX, remember SPY went ex-dividend, so we got the gap fill and bounced today. So let's keep it simple here. The 20 MA has been the support. We didn't quite get a move to the full low of the diamond. If tomorrow is above today's high of day, I think we're going back up. So I think you could buy stop us up over today's high in SPX. If you lose the low of day, it's so close to the 20 MA, I think we could migrate down to like the range low of 2415, like that area. The 6-9 range is very important to me. That was that sort of middle piece to the diamond. Above that high, that was 2446.20 is bullish. Below that low is more bearish for me for a retest of 2400, which is roughly where the 50 MA would be at that time. So today's range is important. I would be willing to play either long or short, either short below or long above. IWM, not surprisingly, was weak, very weak actually. This stalled. Remember I said that 140.86 was key? We stalled at 140.80. Above today's high of day, I would say would be long for a retest of the highs. Below the low, I think you'd at least see the 50 MA, 100 MA confluence around 137.65, 138.17, that area. This was a look above and fail, and now coming back down. If you lose today's low, I think it's a quick short. Above the high, I think it's a long, because you have 2 days worth of highs that are above there, and I think it would catch a lot of people by surprise. And the Qs I mentioned are just in a bit of a bear flag. Below the 20 MA, it's in ping pong range between the 20 and the 50 MA. If you break the 20, you probably will float back up to retest like 142s. If you lose the 50 MA and those reference lows, like I said, I think it's going to retest the breakout in the 132s. So that's my view. Anyway, if you missed this video, you can catch it again. It's going to be rebroadcast as soon as it finishes processing. If you like this video, do me a solid and retweet it on Twitter. My handle is @JustinPulitzer. If you're not following me, I don't know what you're waiting for. And be sure to hit the subscribe button. You'll get notifications when I post new trading videos. There's a little bell next to it also. I highly suggest hitting that. I don't post pictures or videos of me doing anything with like puppies or kittens or whatever. This is a pure straight up trading channel. You'll only see trading videos on here. So You want those notifications. You need those notifications. You can't handle the truth. Anyway, have a great rest of your week. I will post on the stream, and I will see you on Sunday for the weekend review video. Cheers.